Evening, the Reserve Bank has proposed a scheme to alert banks through a helpline to companies that are on the verge of becoming NPAs. In fact, it has asked banks to reconsider converting unsubstantial debt into equity or preference shares with adequate provisioning. Latha Ve, who broke the story, is with us. Latha, what are you picking up? How can this pan out? And by when can we expect some kind of containment of bad loans?
RBI is telling banks to look at their list of companies which are shaky, which can become NPAs, and try and save them by reducing their debt. There are a lot of steel companies which have high-priced capex projects, and their current EBITDA cannot service the entire interest cost. So RBI is telling the banks to carve out the unsustainable part of the debt and convert it partly into preference shares and partly into equity. Now, when the debt becomes equity, banks become part owners. The promoter loses part control over the company, but the banks are also losing because they don't get any interest for the converted part. The preference share will hardly earn 1% dividend, if that. The upside is if the company recovers and if steel prices recover, then they earn, their shares will become expensive. And because they lose interest at this point in time on the extent of debt they are converting, that has to be provided for, 20% provided upfront and the balance provided over 4 quarters. I spoke to Arundhati Bhattacharya about this plan, and she was hoping, as many bankers are, that RBI will give a longer time to provide for the hit that banks may have to take. I understand that there is a program, there is a talking underway to separate sustainable and unsustainable debt, to convert the unsustainable debt in such a way that both banks and promoters take a hit. What are the ideas that banks and companies can work with?
Well, I think you've already laid it out as to what we are thinking, and proposal we have already made to the regulator. So it is not something that the regulators are not aware of. The industry has already made such a proposal to them. The regulators are obviously going to look at it very, very closely to see how it is, how it could be acceptable. They had allowed this when the ARC sales were happening, if you remember. They had allowed 8 quarters for any hit that was taken in respect of ARC sales to be written down. So something similar on the same lines.
So who loses and who gains? Banks will have to suffer higher provisioning currently, but that will save them from accumulating future NPAs. For some companies like maybe Bhushan Steel or other companies with high-priced steel, this is a high-priced capex projects. This is a boon if banks agree to convert the part of the loan into preference shares. But I'm sure banks are going to squeeze their arm twist them into selling off a lot of non-core assets before the banks take their own hit. The entire process will have to be vetted by a high-powered committee comprising a High Court judge investigating a former CVC. That committee is going to be set up by the government very soon, and Reserve Bank's own rules on this kind of debt restructuring are expected shortly, early next week.